Okay, we're going to look at Yahoo Finance now to see what's going on with the stock market. We see that there was an inflation reading that came out today, CPD, I think it's called. The big news for the stock market is the U.S. 10-year Treasury yield went up a lot today. So we know, we've been saying this for months now, the 10-year Treasury, as it goes up, the stock market goes down. And we've had the U.S. Treasury in a downward market, downward trending, lower highs, lower lows, and the stock market's been going up. But today it's up a lot, so the stock market it seems like it's going down. So you can see, let me see, we have a lot of, we have the earnings reports finalizing this week. We had earnings from Micron and Nike. Let's look at some of the market movers going up and down today. We have some financial companies going up today. A lot of regional banks. We have Capital One. We have Citizens Financial. Okay, a lot of banks going up. And we have Nike going down 20%. Let's look at some of the financials on Nike. You can see that Nike isn't growing anymore. These are the annual earnings estimate. You can see from the estimates going out a couple of years. Basically from the year 2024 to 2027, there was zero growth. So basically this is a dividend stock for the next couple of years. And it's really expensive right now. It's trading at a high PE ratio with zero growth. And they have very cautionary forward projections for the company. So this is an example of a stock that's not growing for the next couple of years. And there's indication that the consumer might be not spending as much, which is bad for the United States economy. Let's look at the S&P 500. We can see that we're still in an overbought state. We're at 76 in the stochastics. The time to buy is whenever the stochastics are below 10. Right now we're overbought still. So we're going in. Okay, so we are still above most of the moving averages, which is a positive for momentum. Let's look at our calendar. So we're at the end of June. Usually there's quarter end window dressing, but right now we're overbought in the stock market. So that's why I had very cautionary. We're probably going to go down in the near future. We do have July 4th holiday. This is one of the most visible holidays of the year. Everyone looks forward to the 4th of July. It's a big event. And usually the stock market goes up around then. So that's why right now we're still overbought and going down in the stock market. So perhaps we'll be going down for a couple of days and then we'll be going up around the holiday. Let's look at, and what do we have to look forward to? We have a Fed meeting date at the end of July. There's a very good chance all the futures are saying that we're going to be doing an interest rate cut with the Federal Reserve right around September, maybe one cut. But September has been traditionally a bad month, and so has August. So that's the big picture. Let's go back to our talking points. US 10-year and 2-year are up since last week. So as the US 10-year and 2-year goes up, the stock market goes down. That's why we probably gonna have some stock market going down this week. Let's see what else is happening. Okay, so we had big news for yesterday. Right. Okay. Okay. The big news for yesterday, we had a debate, and Trump did pretty good on that debate. And looks like the president, Joe Biden, he didn't do good. So a lot of the stocks revolving around Trump being the president, we're doing good after starting today. Um, let me see. We also have one of the seasonalities to remember. Before the late election, we have stock market usually does good. And okay, we're still in June. This is one of the worst months for stocks to this point. And what else is there? Okay, we're keeping track since the beginning of the year. The stocks that did the worst last year. We're keeping track of those: utilities, energy, financials, telecom, and healthcare. We're keeping an eye on those as possibly ones that will be better next year. Let's look at our seasonality index. Okay, June has like been a flat month for the past 20 years, 40 years. August, September have been bad months. July has traditionally been a good month. So we're exiting June and going into one of the more positive months of the year. So with maybe a sell-off today, we'll maybe go down to an oversold state for a rally after July 4th. Let's look at the S&P 500 trend line. You can see it's a very, we have momentum in the stock market. We're overbought. We're at 70, and we're right in the middle of our trend line. We have some room to go to meet the bottom part of our trend line, and in July we could possibly go back up to the top of the trend line. So we are overbought now. So the fast release resistance is down. So there's a very good chance we'll be going back down to the bottom of this trend line. All right, so we looked at the U.S. 10-year Treasury today, and it was up. As you can see, we continue to have an inverse correlation with the stock market. So the same thing with the 2-year Treasury. You can see as the Treasury yield goes down, the stock market is going up. That's the opposite today. If we look at our US 10-year Treasury today, it's going up and the stock market is going down. You look at 1 year. Okay, there it is right there. Whenever the report was released, the yields go up, and the stock market goes down. The stock market is purple, the yields are blue line. So what that tells us is the stock market is very sensitive to interest rate increases and decreases. So the premium that people are willing to pay for a stock in the stock market is less as interest rates go up. So let's really keep in mind. Okay, so what else is happening here in the stock market? GameStop stock rises after Warren Kitty returns to social media. This is such a scam. I would stay away from any of these stocks. They're not profitable, and it's like gambling. It's just a good way to lose money. And it's Warren Buffett went known for 5 minutes. So let's see, what other things are going? Okay, Trump media is here dip after being on Biden shaky debate report. Okay, so Trump media is a stock that basically is losing money and it's on a path to bankruptcy. And And right now it's just a trading stock, very similar to the game stock. So it's not something to invest in. Um, okay, those are good little good. Okay, let's go back to our talking points. Okay, I'm not our variables to the stock market haven't changed much this week. So it doesn't really tell us the price of oil stayed the same. We have inflation just a little bit lower than last week. We had a tame inflation report today. The US dollar hasn't changed. The gold is down a little bit. So we don't have a whole lot of um, things that could affect stock market. Fear and greed index is neutral now. So people are getting less fearful and getting greedier. Um, and the AAII sentiment survey are the people are both. So this is another indication. This is another reason why we have yellow or caution in our calendar, because whenever people are bullish, especially young investors or investors that are new, um, amateur investors, get to be cautious. All right, so the VIX is still relatively low, so that's people aren't afraid right now. And right now, people are neither fearful or excited. So right now we're just like in the medium. Just kind of waiting for something to happen, good or bad. Um, to review, whenever people are enthusiastic and greedy, that's not the time to buy. It's the time to either sell or don't buy. Whenever people are capitulating and afraid and in despair and fearful, that is the time to start looking to buy things. I'd say a good portion of my portfolio I bought during the crisis in 2008, the financial crisis. I bought Google, um, and during the 2020 crash, I bought the majority of what is my portfolio right now. So whenever people are in despair and capitulation and there is no hope, you got to look and see if there is any reason for stocks to go down if you're watching. Um, okay, we haven't had any issues that may lead to a crash that come up this week. None of these issues are are becoming so bad that it would cause a crash. So we're keeping our eyes on them because um, any one of these could make the stock market flip. Um, okay, so as far as our sectors, our sector performance, year to date, we have the S&P technology sector up the most. The communication sector is they're both up. They both have similar stocks. Um, that's the reason why they're up about the same. We have the financials doing good and utilities doing good. And if we look at our worst to first, last year healthcare, energy, consumer staples, and utilities did the work, and now they're actually doing pretty good. But the IT and communication services are still doing the best, and they're looking to do as well as they did last year, actually. But consumer discretionary, which they did last year, is doing the worst this year. All of us, well, no, it's not doing as well. It's up 6%. But the real estate is still struggling, primarily because the interest rates haven't been reduced, making it harder for people to buy houses and refinance um, real estate. Okay. So, no. All right, so let's look at more what's going on in the stock market now. Okay, look at the sectors that are doing good and bad. The sector ETFs The ones that are doing the work are utilities. Why would utilities do that? Let's look at the 10-year. As the interest rates go up, the, the anything yielding higher would be under pressure, because if you have a guaranteed return on a treasury, you would not want to take risks buying stocks that have a yield or utilities or any high yielding things. So anything that yields higher will be under pressure today, because there's an alternative of buying a secure US treasury. So let's look at all the sectors. Okay, so we have high yielding consumer discretionary vehicle. These are high yielding. So you have competition between the US Treasury and high yielding different sectors. And as these rates go up, companies that need to borrow money will be under pressure also. So that's why a lot of the sectors that are going down today are companies that need to borrow money, such as the biotech. Biotechs are very small companies that need to borrow. And we have okay, so US real estate is under pressure as the rates go up also, because people can't afford housing and refinancing and mortgages if the rates going higher. And why, I'm not sure why regional banking is going up. We have the retail going down because Nike had a bad earnings report. And as a lot of times whenever one stock in the sector goes down, a lot of the other ones go down extensively. The ones who are doing the best today are regional banks. So this is, I'm not sure what correlation they have with the treasury, but it seems like they're all going up. Today we have telecom sector, which is usually high yielding. It's going up today. The oil service is going up. So oil, let's look at the price of oil today. Oil is down just a little bit, but we have a lot of the oil sectors going up, and it could be because Trump did really good yesterday in the debate, and if Trump does good in the debate, he's going to be very nice to the oil companies, allowing them to do whatever they want to do in exchange for any kind of money for his campaign. So that is probably why the oil companies are up today. And that and that narrative alone could cause the oil and energy stocks to go up. That is, the Trump presidency could cause that sector to turn around. Let's look at the stochastics for the oil stocks. Here it is. XLB. There it is. You can see it's in the downtrend right there. And since at least April. So the sector hasn't done that great. If you look back the whole year, it hasn't gone anywhere. So it hasn't been one of the better sectors to be in. But the possible Trump presidency, along with the possible resolution to the Ukraine situation that Trump promised if the debate, that could cause oil prices to go down and allow oil. And if there are restrictions for oil companies now that are lifted, that could help the oil energy sector. All right, let's look at more what's going on in the stock. U.S. market. Okay, so we have the okay. So let's go to some of our talking points. which we'll go back to our stocks later on. We see a couple of themes here. One is steel companies. Nucor is a steel company, and we have it could be up because if Trump is president, there are going to be tariffs on materials coming into the country, and if that happens, a lot of the materials for steel companies, for steel dynamics, those companies could benefit for less competition. So let's review some of the implications of having a Trump presidency. Okay, there it is. Okay, so last night, if Trump wins and follows through on his America's First policies, we could have a bunch of different sectors affected by this. So as Trump improves in his polls and possibilities to be a president, there's a couple things to think of in investing. Number one, he's going to impose tariffs on imports. So that's going to affect the steel companies. That's going to help the car companies like General Motors, the steel companies like Nucor. And I'm not sure why, but natural gas company like Cheniere Energy, they export natural gas. So this is something really important to keep in mind. Of course, oil is going to be affected. It's going to help the oil companies because Trump is going to allow oil companies to drill more and to make more profit. And he's already had meetings with oil companies in exchange for maybe some donations. They'll be nice to them. So the other thing that I've noticed whenever Trump was president, it will also introduce uncertainty and volatility in the stock market. So I remember whenever he was president last time, you never knew what was going to happen tomorrow, if he's going to say something random that would affect the stocks. And that introduces uncertainty and volatility. And the stock market doesn't really want Trump to be president, I think, just because of that. Because basically, if you introduce tariffs, for instance, on all imports of materials, that totally affects the cost to do business, and that totally messes around with all the earnings for a lot of companies who are following. So that introduces uncertainty. We don't know how much that's going to affect the bottom line in a lot of stocks. So, believe it or not, a president could affect profitability of companies. We just don't know. All right, that's something to keep in mind. All right, I got some talking points here. Let's go through some of our. Okay, let's keep in mind Dan Niles at the beginning of the year, he chose Meta, Amazon, Text Instruments, XBI, and KWeb as his top picks. And Amazon and Meta are continuing to do very well. Amazon went up like 10% this week alone. Texas Instruments is starting to do really good. But his biotech and KWeb, which is the Chinese ETF, the tech companies, they're only up 4%. And they're not doing that great. But so far, these picks are doing really good. We're going to follow Dan now trying to say something. Here's some charts to keep in mind. Okay, NVIDIA has been pretty volatile recently after it split. You can see it's getting to a point where it's oversold and near bottom of one of its trend lines. If it breaks through this little trend line here, it'll probably go back down to this trend line right here. It doesn't have any catalyst until earnings a couple of months from now. So we're going into the summer doldrums. It's most likely going to settle down at the bottom of the range. Let's look at another stuff here. It's Tesla. You can see this is in a downward trend. The earnings are not as good as they used to be. They're overbought and they're top of their trend line. It looks like going into the summer time without a whole lot of news. It could gravitate towards the bottom end of the range. It's going to continue to downward trajectory. The only intangible about Tesla is possibility of products that aren't in estimates right now, such as robo taxis and robots. Um, but right now, we have to look at our earnings estimates for the company, and they're not doing that great. Here's an example of a stock that's oversold. One of the stocks we're following, it's oversold, and it's at the bottom of its um, upward trend line. So this is Tractor Supply Company. I like to always, whenever we're following like 20 stocks, and most of them are overbought right now, but this one happens to be oversold and at the bottom of the trend line. Here's an example of a stock we're following also totally. It's pretty pricey right now. It's like a couple times higher. It's the tag ratio is around 3, so it's pretty expensive. It did a split, and as soon as it split, it started going down. And that's like it's called buying a rumor, selling the news. And right now it's at the bottom of its trading range, its upward channel, and it's almost oversold at 40. But anyway, it's still oversold. I mean, it's still overvalued. So I thought that'll be interesting to cover that. Indeed, right now is at the bottom of its trading range. You could be going into a summer time with a lot of our stocks where they go sideways. A lot of the stocks we're following are starting this sideways pattern because in the summertime we don't have earnings reports coming out. People are on vacation, and there's not a lot of catalysts to make stocks go up. And so that's why I'm starting to draw these trend lines going sideways. Right now we're at the bottom of our both sideways pattern here and our upward trajectory. So and we're halfway between overbought and oversold next to that. All right, so today we had an inflation gauge. It showed that the inflation is not going up as much. And you can see it's going in a downward trend, it's CPI. So that's good for the stock market. So if inflation is slowing, you should have had the 10-year rates go down today, but they went up. So I'm not sure the bond market is smarter than the stock market. So whenever we see the 10-year going up, there's something in that report that people didn't like. The bond market didn't like. So whenever the U.S. Treasury goes up, this is a signal the stock market's going down. So I was surprised with the rates going up today, but that's can we help. Let's look at some more quarterly reports for different funds. We have a mutual fund called Fidelity Zero, and this is the holdings in 2021 versus now. The big difference is our NVIDIA was added, and we got Reliability and Broadcom. So the ones that were removed are Visa and JP Morgan. So this kind of is similar to the other Fidelity funds we're following, Fidelity Magellan. The interesting thing, they're adding Broadcom. You went over this last week. Broadcom is a company, I was researching it. It's actually pretty well positioned for the AI build out of the infrastructure. They have VMware as a product, which is a software product for infrastructure, and they have chips that they're manufacturing, and they do a lot of the software, for the infrastructure. They bought Computer Associates a while ago, so they have a lot of software, which has a higher profitability. But it's pretty expensive right now, and they announced the split, so we're going to follow this one, but it's not going to be something you can look at right away. You can look at it right now. Of course, we're following Eli Lilly and NVIDIA. Both of them are pretty expensive right now. Let's look at another one, JP Morgan US Tech Leaders. JTEC is the name of the ETF. And I'm comparing 2020 to now. And the ones that we stocks were added are NVIDIA, Meta, Oracle, Synopsys, Amazon, Netflix, and Taiwan Semiconductor. They really turned over their portfolio. They kept Alphabet, AMD, and that's it. So the ones they removed are Tesla, probably because Tesla is not as profitable as it used to be. Mass-produced analog devices, Paradigm, PayPal. So this is great. None of these aren't any stocks that we're actually into right now. So that's good to follow these every once in a while. And the great thing about comparing year over year is for the stocks that are kept in the portfolio, these are stocks that you really want to consider for a long-term portfolio because there's a very good chance that those stocks are going to be doing good over a long period of time. All right, so this is an example. We went over Walgreens a couple of weeks ago, and they went down a good 20% recently this week. And there's an article, Walgreens cuts EPS guidance, plans to close more stores. So this is an example. We like to go over stocks as examples of stocks to avoid. And we were talking about the challenges of these CVS and Walgreens. We were talking about the challenges that these companies are having because their business models is really challenged. If we look at their Walgreens number, the forward PE is only 3.77. That is just an amazingly low PE ratio. But their profit margin is negative 4.8%. That's bad. And their return on equity is negative 57. So these are like super bad numbers. Let's look at the earnings summary. Their earnings projections for the next couple of years are going down. So this year it's $3 a share. Last year it was $4 a share. So it's been a downward trend. These are kind of the stocks we want to avoid. It's going down and the earnings estimates are going down. The stock price usually goes down with it. And in addition to this, you can see that it's been going down for a while now. The challenges for this company are that shrinkage is whenever you lose products to losing it to people stealing it, and losing it in supply as put out under the floor, etc. Now we have competition from other pharmaceutical companies like CVS, Walmart, and now there's a cost plus company that actually is a competitor, a different business model. And Amazon is actually sending out prescriptions through the mail. So the business model of pharmacy companies are being challenged, but that's bad. So they're losing a moat they used to have. They used to be one of the only places to go for pharmaceutical services. Now the retail business is challenged by Amazon and Walmart and other companies. So they don't have a moat, and their earnings projections are going down. And so we like to follow companies like this as stocks to avoid. Now, if these earnings estimates start going up and they have some kind of catalyst, we'll look into it. But This is a good example of something we avoided a couple weeks ago when we looked at it, and it's a good thing we did. All right. So I thought it'd be interesting to, on the flip side, is go through a screen just to look for some stocks. We like to do this maybe once a month. Let's look at some of the fields that we put into our search. We have return on equity. We want that to be greater than 12. We want the profit margin to be greater than 12. We want market cap to be, we want it to be a bigger company. With the forward PE lower compared to the growth rate. We want the growth rate to be at least greater than 10 and sustainable. And the PEG ratio, we try to buy it around 1 or lower, but if it's a good company, we can pay more for a PEG ratio. So that's our input for our screen. And this is like, we want the earnings estimates to go up. You can see how this is a contrast to the Walgreens we just looked at. So the Walgreens, you can see that forward PE is down great. We like the forward PE before, but profit margin was negative, return on equity is negative, and this company also has 34 billion in debt. That's like 3 times their market cap, which is very dangerous. So and their earnings estimates are going down. So this is like the opposite kind of company we're looking for. So putting all these numbers into our Fidelity screener, we got a list of stocks again. A lot of these are stocks we've been following for a long time, like MasterCard, T-Mobile, and what is that? Okay, we have a couple of stocks that we've been following for a while, but I thought it'd be interesting to highlight some stocks that have a PEG ratio less than 1. So we don't have a chance to go through all of these right now that have a PEG ratio less than 1, but I thought it'd be interesting to go through the one with the lowest PEG ratio, 0.34. Okay, this is Synovus Energy, that's CVE. It's a smaller cap company. We have a market cap of 36 billion. That's pretty small, but still. We also have a company called Baker Hughes. They're a spin-off of GE. They have a PEG ratio of 0.59. So the thing of a lot of these have in common, these are energy companies. We have a lot of energy companies in this list. Energy is out of favor right now. So as a contrary investor, you have to think opposite the market sometimes. Like Diamondback Energy, they're an energy company. And we also have this the catalyst, possibly it will affect Trump presidency. That could help that sector. And an end to the Ukraine war. That could help oil also. Okay, let's look at Synovus Energy just a bit. We see that it's in an upward trending estimates. So for some reason, I don't know why, but in 2027, we have a double of earnings in 2026. We'll just have to figure out why that is, but temporarily, it's been that's an anomaly. Right now, the PE ratio is 10, and it's growing at around 20%. And so its PEG ratio is 0.5 right now. It's like half price. But you have to keep in mind, energy companies are very volatile. You have the mercy of the price of oil. So even if the company executes perfectly and has defense management and has all the earnings estimates ready to go up, if the oil price goes down, the stock, these estimates are going to be thrown away. So that's what you got to keep in mind when you own an energy company. Another good thing about this company is they have a dividend. And so that allows you to at least have a dividend while you're waiting for this growth to happen. All right, so the other energy is out of favor now. You can see the downward trending in the energy ETF. And Trump might win the presidency, and that could help energy companies. Let's look at some of the CVE's statistics. You can see that their first thing I look at is their total debt is 9 billion out of 36 billion. And that's pretty manageable. The Their forward PE is 10, which is pretty low, and they have good profit margin, and they have a good return on equity. So this looks like a pretty decent company, and they have a dividend of around 30%. So, but it's smaller, and this is a good one to keep our eyes up for now. All right, we already talked about okay, so I think that was a good third. And let's look more what's going on in the stock market. Some things we didn't look at yet. Where the stock market is now. Okay, stock market is turning a little bit lower. Um, so okay, the some of the news I'm seeing a lot of is there's a lot of pushback by lower earning consumers that don't make a lot of money. And a lot of the companies like McDonald's are saying that customers are pushing back and not buying because they're raising their prices and their customers are price sensitive. So that's leading to a possibility of a slowdown in consumer spending. And if that happens, we have a recession. We have, oh, trading GameStop. GameStop was like gambling. This trader from the New York Stock Exchange. So that's why I say just try to stay away from anything um, that's going into around mem stock. You see. But in general, the presidency, um, people wondering if the presidency does better or worse under Republicans or Democrats, and it's basically the same performance. And stock market adjusts to changes in politics. You don't actually put a lot of um, effort into predicting the presidential outcome or Congress outcome, because a lot of times they did studies where the stock market does just as well and just as worse in Republican or Democrat presidency. So even though we're talking about the oil sector doing better under the Trump presidency today, in general, you have just you have equal performance in the stock market in one presidency versus another. So that is what I have to say for today. I hope you had a good time, and I hope you have a good next week of investing. All right, well, I'll talk to you later. See you next time.